Alright y'all, welcome back to another video. This is your boy Jay Devar, your favorite sneakerhead vlogger and entrepreneur, back at it again. And in this video, I'm actually going to be sharing with you guys like how I basically trade the ICT concepts that I learned in the ICT 2022 mentorship. So yeah, stick around for the video, and I'm actually gonna show you guys like how I actually go about my top-down analysis all the way down into like my scalping entries. So, crap, hold on. All right, so as you can see, I start my top-down analysis on the daily time frame right here. You see we're on the daily time frame. I've been liking back testing on SPX 500 because like it's just so smooth, and it oftentimes it respects its levels a lot more. This pair and NAS kind of correlate together, except NAS 100, the NASDAQ, it tends to wick a lot more. Meanwhile, SPX, it tends to be a lot more cleaner price action. So I'm not getting stopped out as much. I used to trade NAS a lot more, or back test demo trade on NAS a lot more, and normally my stop loss would get hit a lot more because of the wick. Like I said earlier, like it wicks so much. But SPX, it tends to respect its levels a lot more, and then the price action tends to be a lot cleaner. But that being said, so right here on the daily time frame, this green box that I have marked right here, this is basically a breaker block. This is ICT bullish breaker block, right? That's why I have it green. And basically all a breaker block is just it's basically a failed order block, right? So right here, this would actually be an order block, a bearish order block, if it wouldn't have got, if price wouldn't have ran through it. If price would have came up and respected it and headed lower, taking out some of the lows right here, then this would have been an activated bearish order block. However, the fact that price went ahead and traded through it, that means that the bearish order block, or the bearish sentiment, or the bearish analysis, my bad, the bearish bias, yeah, that's what I'm looking for. The bearish bias is now invalid. So now this becomes, so although the bearish bias has been basically taken out or deleted and not a factor anymore, this is still the area that price is most likely to come down and retest into, because this is still considered like a fair value of price right here. So and as you can see, that's exactly what price did right here on the daily time frame. Looking at it from a daily perspective, it came a few days later, and tapped right into this bullish breaker block right here. It tapped into this bullish breaker block right here and headed higher to take out some more buy side liquidity on the daily time frame over here over the next couple days, about a week or so. And it came to tap into this buy side liquidity right here before making another rally down. All right, so that being said, this is a key level that I would have been paying attention to right here. And as a matter of fact, the scalping strategy, or I'm gonna show you how I trade it. We're gonna be looking at this candle right here, not this one, Thursdays. We're gonna be looking at Thursday's candle right here, because I normally don't like to trade on Fridays. So we're gonna look at Thursday. Back test what happened on Thursday. So this is the candle we're gonna be analyzing right here, the 15th of September. So the next thing that, and as you can see, I have some more levels marked up here. This is a failed bullish order block to the upside. Price traded through it, and also not only did it trade through, but it also formed a bearish order block. You can see right here, bearish order block right here. So not only is there a bearish order block right here, there's also a bearish breaker block right here. So this is most likely an area that price is gonna come up to, because at this point this is gonna be a premium with the rally that it made down here to these lows, the retracement back up. this area would be considered a premium level. And when markets move to a premium level, that means that the basic supply and demand. The more supply you have of something, the less the price is. The more demand you have of something, the more that the price increases. So, basic economics 101 basically. So price comes up to here, taps into the premium level. At this point, the major banks and institutions, big institutions, they're like, okay, we took price all the way down from the 3,900 levels and pushed it all the way back up into the 4,115 levels. That's a big price move, right? So that's like a $200 price move, somewhere around there. So at this point they've made everything $200 more expensive. So it's like when you get so now they're looking at like, okay, do we want to continue to pay a premium to drive price higher to make more money, or would it make more sense for us to go ahead and start selling off our positions, right? Making money this way on the sell. And then what that means, and then when we get to an area, as you can see right here, price came down right here and tapped into a bullish order block right here. Actually, I'm gonna mark this bullish order block. I'm gonna mark this a different color. Let's say golden zone. The price came here and tapped into this area. Now this is an area of supply. Alright, this is the area of supply right here. So now they come down to this level and they're like, oh, okay. So now we've effectively sold off price from the 4,100 levels all the way down to the 3,800 levels. Now this is an area where we may consider to start buying up, because now everything is at a cheaper price than what we were buying at before. So now we can make a little bit more money on the way up, and then whenever we feel like it, we can start to drive price back down again, or upwards, or however, whatever other economic factors are going on in the economy. So, but back to that. Now we're gonna get off the daily time frame. I was anticipating price to head lower, into possibly head lower below this daily bullish breaker block, because we've already come and tapped into this area twice already. And normally when price comes and taps into an area around twice, it's at that point where I kind of expect these levels to be basically traded through or broken through. Especially if price then trades down below this area, below this bullish order block right here, then this will turn into a bearish breaker block right here. If price comes and trades below it right here, takes out these lows and everything of the sort right here, probably I'm actually anticipating it sometime in the next couple of months to probably go ahead and take out these lows right here. So probably go ahead and take out this low right here, the 3,600 level, because I have another level down here where I'm expecting the price to take it out, because we have a lot of price action down here, or a lot of basically have a lot of gaps down here that need to be filled in. And given the current state of the economy, how everything's going, the government still raising interest rates, trying to combat against inflation. So yeah, I can definitely see higher prices, not higher prices, but lower prices among all the indexes. I can see the dollar, the DXY rallying again, but that's another story. I'll make another video about that. But all right, so now we're gonna get into actual going down the time frames. So from the daily time frame, next I go down to the 1 hour. All right. So you can see here on the 1 hour, a lot more information on the 1 hour time frame. I see a big, huge gap right here. A huge gap right here. So I think, well, this is a huge fair value gap right here. So I think eventually price is gonna come back up into this area, take out all of this buy side liquidity right here. Basically, like all of these equal highs, relative equal highs right here. I think price is gonna come and take this out because I already took the sell side liquidity right here. And normally when price takes out sell side liquidity, then it makes a run on the buy side liquidity. So around next week, I'm gonna look to definitely see about higher prices. Yeah, I'm definitely gonna look and see about higher prices going into next week. Taking out this buy side liquidity and potentially tapping into this area right here before selling off again. Probably come up somewhere near this area and then sell off again, or it might just touch this order block again. But so that being said, we have that. So now I go down to the 15-minute time frame, and on the 15-minute time frame, I want you to pay attention. This is a key point in my strategy, or a key area in my strategy. All right. So on the 15-minute, actually this is Friday. Yeah, that's right. Thursday. Pay attention. Thursday right here. Wait, is it Friday was the. Okay, never mind. We're gonna pay attention to Wednesday. Wednesday is actually a lot. Friday was the 16th. Yep. Alright, so we're actually gonna be paying attention to Wednesday. My bad, not Thursday. Thursday didn't really have as you can see, it wasn't really any major move Thursday. Well, it kind of was, but that's not the area I want to focus on. This is a lot cleaner right here. Or I see more opportunities in this one right here. So I go down to the 15-minute. This is where I look to take my entries. So as you can see right here, we've already identified this as buy side liquidity. If I were to come clean it up a little bit right here, so we'll do this. All right, so this is what I want y'all to pay attention to right here. You see this little gray highlighted area right here? So from about, it says 6 o'clock, but it's supposed to be 5 o'clock. But from 5 o'clock all the way to 1 a.m. This is the Asian session range. You can see it right here. I have it right there. But this is the Asian session range right here from 5 p.m. 5 p.m. is basically the market close for the U.S. markets, for the U.S. banks. And then from here on out is where the Australian and the Asian session starts to kick in. All right. So from 5 p.m. to 1 a.m., this is the Asian session range that I use. I know a lot of people do other times, like probably like 7 to 12 or 8 to 12, 8 p.m. to 12 a.m. That's completely fine. But yeah, I personally use 5 p.m. to 1 a.m. And the reason why I input the Asian session range into my trading is because this is the market close, right? Or this is the US close right here. And I normally trade in the US session. I'm gonna mark that now from 7 a.m. to 10 a.m. That's the New York session kill zone, right? This is the window that I trade between. That I back test and I trade between. This is the time that I go back and back test if I miss it, because I still working every day. And on my days off, I actually come and trade the session live. So I'm taking demo trades live during the session, inputting everything I learned from my back testing. But so the reason why I use, back to the Asian session range. The reason why I use the Asian session range is because the Asian session range usually sets the high and the low for the next day. And when it sets the high and the low for the next day, I'm expecting one of these areas, I'm expecting either the high or the low to be taken out first. Because normally what happens is when price comes and takes out either the high or the low in the Asian session range, it's setting up the next move in the next session. So you can see right here, you see this little choppy price action here in the Asian session for the SPX. for the S&P right here. It's a little choppy, but however, it set the high and the low for the next day. And as time is going on, as you see right here, the 1 p.m. from 1 a.m. into the 2 a.m. to the 2 a.m. to 5 a.m. time. This is actually the London session. This is the start of the London session. So like from 1 to 2 a.m. all the way to 5 a.m. Right here, you see you see this break below the low that was set in the Asian session range. This the day's low. The first day's low was broken in the London session. We'll take it out, and now it's heading higher. Right. So in the London session, so the move from an Asian session is setting up a move for the London session. So you see the Asian session had a retracement down lower, and that led to the opportunity for the market, for the price to mitigate, or basically make a run on the sell side liquidity of the Asian session low right here. So Asian session low right there, and now it's making its way higher. And normally, also what happens is it'll come up and then take out the day's high, the first day's high. When it does this, takes out the first day's low, it normally makes a run on the first day's high. And then from here on, when it takes out the first day's high, one or two things can happen. Either it can make a rally higher, because it already ran the sell side down here. It could either make a rally higher, continue in the London session, and then move on into the New York session. The move that's made in London session can set up an opportunity in New York to where there's a retracement, and then you find an entry there and head higher, probably to tap into, you know, some of the areas that I have marked up here. So what could have happened was price could have came, took out, and completely just took out the buy side here, set up a move in the New York kill zone session, and come down and make a run and make some higher highs and take out some of these higher lows right here and make its way up into this area. That is scenario one. Scenario two is exactly what happened right here. This is exactly what we're going to be looking at. So in scenario two, right here, as you can see, price came, slightly tapped into the buy side liquidity that was over here. Didn't really make a run above it. I would have preferred to see a run above it, you know, but it didn't necessarily do that. So it came tapped and headed lower. And as you can see, it headed lower and just completely took out the new sell side liquidity that's right here, or the new lows, the new Asian session lows. Not new Asian session lows, but the new daily, the new day's lows right here. So we can put sell side liquidity right here. Came and took that out. So now it's at this point where I'm looking and I'm paying attention to everything that's going on. So now, basically, when it comes to the 7 a.m. and the 10 a.m. New York session kill zone, right? When it comes to this is what I'm doing. Right, so now we're gonna actually get into the entries part of the strategy. This is what I'm doing. I am looking, everything that I just explained that happened over to the left, I'm looking over here to see what happened, so I can gauge or see or forecast basically what's possible, what's most likely to happen next. So if I would have been on the charts at 7 a.m., right, I'm in place, looked at everything to the side. I'm immediately looking for either a fair value gap or a breaker block of some sort, because the breaker blocks and the fair value gaps, they tend to be close to one another, right? So basically, if you see a breaker block, most likely you're going to see it's going to be in between a fair value gap. So I'm going to go ahead and identify the breaker block right here. Right here, this is a bearish. We've identified a bearish breaker block right here. So sell side breaker block right here. So when it comes to the breaker blocks, you can either use the actual candle, open or the close of the candle right here of like the actual failed order block, or you can use the highest bearish candle, like the last highest bearish candle before the impulse move up. My bad. You can use the highest bearish candle before the impulse move down to turn this bullish order block into a bearish breaker block. Right. So this area is like basically just to get the whole range. Well, actually, this one is to get a more precise entry. This one right here is more so just, no wait, this one is actually to get a percent. No, I had it right. I'm sorry, y'all. My bad, bro. I had it right. This is something I just recently learned in one of ICT's videos. The one that's above the highest, the last bearish candle is the one that's the more precise entry. This is the one, and this is the one that you take if you are just wanting to go ahead and get in at the range. So personally, it doesn't really matter which one you use, but in this case, I probably would have chose to use this one. But like I said, either way, it doesn't matter. So right here, we have this bearish breaker block right here. Right, and as you can see, price came down and rallied back up into this area. This is a bearish breaker block. Rallied back up. Not only do we have a bearish breaker block, but remember what I said earlier, there's also a fair value gap right here. A fair value gap right here. And this bearish breaker block is sitting right inside of the fair value gap. So when I see this is normally where I'm like, okay, most likely price is to come into this area right here. If price is to come and tap into this fair value gap, I'm looking forward to most likely tap into this area right here. Right? Tap into this area right here. But being that it's on the 15-minute, I don't really see an entry that I like. And also too, yeah, I don't really see an entry that I like on the 15-minute. So now what I'm gonna do is I'm gonna scale down to the 5. Now from here, you can take your entries on the 15-minute if, well, I mean, the reason why I'm not taking it on the 15 is because, you know, basically the risk to reward isn't good enough for me. So you see right here on 1 to 7, if I'm taking it right here, actually no, I wouldn't have had to take it right here. I would have had to take the trade. But if I'm entering off the fair value gap, the entry would have been right here, and as you see, that's terrible risk to reward. There's nowhere for me to target really. Yeah, there's nowhere really for me to target. But if I enter here, would have had better risk to reward. However, I would have had my stop loss probably set to here, or I probably would have had it above this candle, but most likely I would have had it above here for a 7 pip stop loss. And as you can see right there, I'm already at a 1 to 5. I normally want a 1 to 2. And the reason why I didn't take it on the 15, or the reason why I wouldn't take it on the 15 is because, like, I don't know if price is gonna actually head down lower into these prices right here that you see. I don't know that. Because price could come here, it could do all this chopping and then just head higher, right? So instead of taking the trade on here, I have to try to go for more pips. I'm gonna scale down to the 5-minute time frame. So scroll over right here. As you can see, it's a lot more cleaner. A lot more cleaner. Right. So actually mark it up like right here. I'm gonna go back to the 15-minute real quick. Cool. Mark it a little clean. Oh shit, where am I at? This is it. Yep. Alright, there we go. Alright, go to 15 because I want to use this area right here. Yeah, I'm gonna use this area right here. Yep, I like that. So I can look like here. Yep, there we go. So This looks a lot cleaner right here. So you see price came into the area right here. Now from here I'm looking to, if I want to take an entry now, I can gauge whether or not I want to take the entry right here. I can take the entry here and I can set a stop either above this candle or above this candle right here. And now more. Alright, so I can come right there, and basically my target is the low. You can either target the close of the candles here, or you can target the actual wick. So like you can target the actual low. Right here you get a 1 to 4. Yeah, right here you get a 1 to 4. There's the reward ratio. Yeah. And that is basically it, y'all. That is if I would have been in the market around this time at 7 a.m. between 7 a.m. and 10 a.m. On basically Wednesday, then this is the actual trade entry I would have took based off of everything that I seen, based off of everything that happened earlier that I analyzed to the left. This would have been the ideal trade setup right here. Would have been the ideal one. So at around 7:25, boom, we're in right here. And as you see, the market just really took off, headed lower. I probably would have been taking partials along the way, but and most likely I probably would have targeted this area right here just to go ahead and grab a quick, like almost 3 to 5. But as you see right there, we have a 3 pip stop loss to make 12 pips. So basically almost a 1 to 4, but yeah, so risk 3 pips, about 12, 13. So yeah, guys, that's how I utilize the ICT concepts for scalping in the markets. That's how I analyze it. And you know, if you learn something, or if this is a strategy that you want to implicate, or you think you can learn a lot from, and potentially make your own, then hey, feel free to watch the video again, like it. But this video is going on pretty long, so I'm going to go ahead and wrap it up here. But yeah, man, y'all do me a favor, like, subscribe to the channel, and yeah, I'll see y'all in the next one. Peace out.